I'm going to share 2 ways to generate an income by selling a covered call. So I own 100 shares of Rocket Companies Incorporated, stock symbol RKT, and I'm planning to use these shares in order to sell a covered call. Just as a quick refresher, I'm going to spend a minute or two talking about the mechanics behind selling a covered call. This might also help some of my newer viewers who are unfamiliar with this process. We start off with me on the left and the stock market with buyers on the right. And I'm going to create a covered call option contract for this fictional company called ABC Incorporated with a 1-month expiration and a $100 strike price. And the reason I'm able to write this covered call is because I actually own 100 shares of ABC Incorporated, the company's stock. So this allows me to use that as collateral. Now, once I've done this, I offer it for sale on the stock market, and then an interested buyer will let me know that they want to buy my option contract, and so they're going to be willing to pay the premium for that option contract. So I receive the premium, and the buyer receives the rights to exercise this option contract if the conditions are met. So using the 100 shares of RKT that I own, I'm going to sell that covered call because there are 2 ways I could generate an income from them. First, I'll collect money for selling the covered call option contract. And then if my option gets exercised, I'll collect even more money and make a huge profit just from stock price appreciation. On March 2nd of 2021, I decided to use the 100 shares of stock symbol RKT to sell a covered call. Now I was going to pick the expiration date of March 5th and use a strike price of $36, which is paying at the time a premium of $1.30 per share. Now my cost basis was $21 per share. These shares were assigned to me when I sold a cash secure put and the market price dipped below my strike price of $21. So that gave me the perfect opportunity to turn around and use these shares to sell a covered call. So this is for stock symbol RKT. And the current market price when I made this recording was $30.02 per share, which makes the value of 100 shares $3,002. Now I chose the March 5th, 2021 expiration date, which gave this contract a length of 3 days. Now with the strike price of $36 and my cost basis of $21, that means my profit from just price appreciation alone is $15 per share. So if this option contract gets filled and executed on or before expiration date, the buyer will pay me $3,600 for my shares, and when I subtract my cost basis, my total profit just from price appreciation will be $1,500. And when I combine that with the $130 I received in premium for selling the option contract, that means my total profit, if fully executed, would be $1,630. And that's a 77.62% return on my investment of my initial $2,100. Let's go over to my account history where we can see the details of this particular transaction. I'll go ahead and click on this transaction and open it up. This transaction's for stock symbol RKT, and I'm selling a covered call with a strike price of $36 and an expiration date of March 5th of 2021. Now I submitted this order on March 2nd of 2021 and it was filled that morning at 9:32 a.m. Pacific time. Now when this option contract got filled, I received a premium of $1.30 per share. So a total of $130 was deposited into my account as a credit for the premium that I received for selling this option contract. This is a daily chart for symbol RKT going back to February of 2021. For our discussion, we want to focus on March 5th of 2021. And RKT closed at $25.10. And the strike price for my covered call was $36. So because the market price never reached my strike price, this option contract expired worthless. And this transaction finished with me keeping my 100 shares of RKT, and I also got to keep the $130 of premium. And so of course the next thing I did was sell another covered call using those same shares and collecting more premium. So this shows how I could use covered calls to generate an income. Now lots of investors talk about using the premiums as a way to lower their cost basis. But for me, I prefer to use the premiums for other purposes. I can put that money to immediate use by investing in other stocks or options, or I can save it for when there's a big dip in the market and stocks are cheap on a discount, or I could withdraw the money for my own personal use. If you enjoyed this video and the information that I shared with you, do me a huge favor and please smash the like button. At this point, I'm going to answer some of the common questions that I received through comments and emails about selling covered calls. One of the first questions I get is, how many shares do I need to sell a covered call option contract? You need 100 shares of an underlying stock in order to sell a covered call option contract. So whenever you talk about, think about, or read about an option contract, always understand and think of it in terms of that one option contract has a controlling interest of 100 shares of the underlying stock. Now, there's one exception to this rule. There is a situation where it's not required for you to actually own the 100 shares in order to sell a covered call. But you're required to have guaranteed access to those 100 shares of stock that you're promising as an obligation in your option contract. So if you own a LEAPS option for those underlying shares, then most brokerages will allow you to write a covered call option contract using that LEAPS option as your collateral. I have other videos that discover LEAPS options in detail. I'll leave a link in the description below. The next question is, what is the collateral and why are my 100 shares used for it? As the seller of a covered call, your 100 shares are used to guarantee the transaction. So when you sell one covered call option contract, you have a legal and binding obligation to sell 100 shares of the underlying stock to the buyer at the promised strike price. So reserving your 100 shares of stock as collateral guarantees that the obligation can be met. This next question asks, can I continue selling a covered call with the same shares even if the contract keeps expiring? Is there a limit? And the short answer is there is no limit. So if you own 100 shares of stock and you sell a covered call using those shares as collateral, and that option contract expires worthless, well then you maintain ownership of those 100 shares, plus you keep the premium payment that you received, and that option contract is no longer valid, which means there's no longer an obligation tied to those shares, which makes them available for you as the owner to sell another covered call using those same shares. And you can keep repeating this process of selling the shares and collecting more premium until the shares actually get assigned to a buyer. So I actually use this process for both weekly and monthly options and keep collecting the premiums that I receive as an income. If you're still watching this video, I just want to say thank you so much. I really appreciate it. And I also want to wish you good luck and lots of success with all of your trades.